Hey everybody, Luke Gromen, FFTT. Hope you are well. Thank you for joining me tonight. I really appreciate everybody for submitting questions. I always really enjoy these interactions. So thanks for submitting the questions, and let's jump right in. The first question is from DF. Can you see a scenario in which asset prices decline while consumer goods inflation rises? I would think it would have to be something that disrupts global supply chains severely again. So open war with Russia and China, one or the other or both, some sort of pandemic, some sort of global or regional electronic magnetic event, right, that disrupts the internet, etc. Those types of things, I think, is what you would need to get consumer goods inflation up and asset prices down, kind of like what we saw in the very early days of COVID. Well, the next question from KP. George Gammon and Joseph Wong discussed yesterday growing foreign concern about U.S. debt to GDP and that it might manifest itself in higher rates for the credit risk. Could we see a situation of plenty of demand just at higher yield, and how sustainable or unsustainable would that be? It depends on the level of the dollar. If you get the dollar up, you're going to have less demand for treasuries. Foreigners have borrowed a bunch of dollars. Higher dollars squeezes that. They have to sell some portion of dollar assets, which they own $18 trillion net. They need to sell some portion of those assets to raise dollars. The easiest thing to sell are treasuries. They own $7.5 trillion of those. So you're going to increase net effective treasury supply if the dollar goes up. So higher dollar, less demand for treasuries. Okay. Lower dollar is all else equal, higher demand for treasuries. However, and the reason for that is lower dollar drives higher global growth, frees up balance sheet capacity, global liquidity, some of which will be recycled into treasuries. It also improves certain FX hedged treasury yields across certain major FX pairs like Japan, all of which means that if you get the dollar down a little bit, treasury demand improves all else equal. However, if you get the dollar down too much, you're going to get inflation to pick back up, and now that's going to hurt treasury demand. So there's a window. Stronger dollar, bad for treasury demand. Little bit lower dollar, good for treasury demand. Lot lower dollar, bad for treasury demand. So there's this window, right? And that window is shrinking as debt rises and as foreign dollar denominated debt rises. So you have this shrinking window, right? Rates, okay, if rates go up, there's more demand, all else equal, absolutely. But to the extent rising rates drives a stronger dollar, we're right back to point one. That's lower demand. That's not necessarily going to help. And so you have this small and shrinking window. Basically, we need a Goldilocks lower dollar. And like I said, the more debt goes up, the smaller that window gets. At some point, there is no level of the dollar where this makes sense relative to where the debt is. The window closes. Once the window closes, you're going to need some form of QE, dollar liquidity injection, maybe even yield curve control. And that is sort of a singularity, if you will, that we are approaching at an accelerating pace. We're not there yet. We're approaching it. We're accelerating towards it. Personally, I don't care about getting the timing right. I own gold. Bitcoin is two of my biggest positions. I'm unlevered. I'm not reporting monthly results, quarterly results, so I don't care. I don't need to get the timing exactly right. But the reason I feel that way is barring an economic productivity miracle, the size and scope of which that I do not see on the horizon in terms of being commercialized yet, it's pretty clear to me where this train is heading. And so I don't know how long it's going to take us to get there. I know the train's moving faster. I know I'm well positioned. And so I'm just sitting back and enjoying the view enjoying the ride and the view and with a popcorn and a beer and seeing how this all plays out. From SP, what is your common man suggested asset allocation to best weather the storm that lies ahead? Many of us have relatively large positions of our wealth in 401k plans and other employer-sponsored plans with limited investment options. How best should the little guy be positioned? These should be taken as rough guidelines, ways of thinking. Everyone's situation is different, so huge caveat there. In my opinion, average person should have 10% of their funds in physical gold bullion, maybe 1 to 2% in Bitcoin. Those two things essentially hedge the currency debasement that seems highly likely to occur over the next 5 to 10 years, if not much sooner. I think with the rest, for the average, within the constraints of an average sort of 401k or corporate sponsored plan, a group of diversified equity funds and some short-term bonds and money market funds, I think you'll do just fine. You're getting a short-term yield, a nice one at that. Equities should do fine in a sort of currency debased, inflationary, secularly inflationary environment. And the thing I would avoid, generally speaking, are long-term bonds. The one caveat to that is to the extent you have a mortgage, and that mortgage is fixed rate, long-term, and say under 4%, I don't think it's a bad thing to put a chunk of that money in your retirement fund into long-term bonds. I would not exceed the principal value of your long-term fixed rate mortgage. My thought here is if you can clip a high-grade bond fund coupon long-term in your 401k tax deferred at, 5.5%, 6.5%, while your mortgage is 3.5%, tax deductible, all of a sudden, you're the bank. You're making a spread, essentially risk-free. Your only risks you're taking essentially that no one's gonna seize your 401k, and I don't think that's gonna happen. So that's the scenario in which I would consider owning long-term bonds. Beyond that, I don't think they're a very attractive risk-reward at all. Term premiums are still negative on 10-year treasuries. That is a fancy way of saying the market is not demanding any premium for inflation risk in 10-year treasuries. Makes no sense. Just means they're being very short-term focused in my view. So those are my thoughts. Like I said, it's a guideline. It's not hard and fast, but those are the types of things. That's how I would recommend to my mom and dad, my mother-in-law, etc. From Husker, yen dollar is back knocking at the 150 level. The higher it goes, the weaker the yen is. Ramifications of a breakout higher. 10-year treasury yields would probably go up sharply, maybe non-linearly. If you look over since 2020, 10-year treasury yields and the yen-dollar cross rate have been very tightly correlated. The weaker the yen gets, the higher the 10-year yield, excuse me. The higher the 10-year goes, it's probably going to be bad for stocks. Equity volatility up. Stock market, broadly speaking, best case probably is just really choppy to down. It's probably negative given the higher rates for housing stocks, commercial real estate stocks. Ultimately, you would expect it to show up in renewed heightened treasury volatility. I don't think it would take very long, and we have, as we've been talking about ad nauseum, seen repeatedly since 2019 how the Fed and or Treasury deal with heightened Treasury illiquidity or dysfunction, which is more dollar liquidity, which is then good for risk, bonds, stocks, bad for the dollar, and we go back to this whole increasingly rapid repeating cycle we've been going through over the last 3, 4, 5 years. So those are the thoughts there. From JM, do you agree with Lori Logan at the Dallas Fed? So, given the rapid decline of the overnight reverse repo balances, I think it's appropriate to consider the parameters that will guide a decision to slow the runoff of our assets. She said this about a month and a half ago, I guess early January. We have had a couple hot prints since then in terms of inflation. All else equal, though, yes, I do agree with her. In my opinion, the why it needs to happen, the why, in my opinion, they are talking about it, is they need a weaker dollar. Back to the point I made earlier. They need a weaker dollar to make the fiscal math work. So bond market's still very focused on inflation, unemployment, sort of the classic dual mandate. It's not paying enough attention still to that shadow third mandate, in my opinion, Treasury market functioning. So critically, a good friend of mine pointed out that summer of 2022, inflation was just way too high for them to not tighten, for them to not keep going. inflation isn't all the way back to their target now, but it's close enough for government work, as my grandfather used to say. So with inflation close enough to their target for government work, it does give them the leeway to ease sequentially at the very least, to keep that dollar moving downward gently. Because again, too much stronger dollar, they got big problems on their hand. They're going to lose the long end. They get a much weaker dollar, they got big problems on their hand. They're going to lose the long end. They need the Goldilocks dollar weakness to try to get through that window, that eye of that needle. So those are my thoughts there. And then the final question from Jason: if China decided to default on foreign debt obligations, how outsized would the impact to global markets be, respective to if the GIE were to do likewise, or maybe UST were to do likewise? My understanding is they hold significantly more of their own debt. Please correct me if I'm wrong. For me, I really don't think China would do that or would even consider that outside of really open war. And the reason I think that is they are successfully internationalizing the yuan for invoicing of oil, gas, and commodities. Full stop. They are. Wall Street Journal end of last year said 20% of the world's physical oil last year traded outside the dollar. A lot of that in yuan. Putin said exactly that basically in his interview with Tucker Carlson 2 weeks ago. Point here is that if they were to default on foreign obligations, that takes all of that trust, all of that progress, and it throws it in the trash. It lights it on fire. And so I think the Chinese are playing a very different game, or have a very different set of goals than much of what I see on a day-to-day basis in the U.S. Western financial media, where it's all about managing the quarter, managing perceptions for the next week, for the next month. What are next month's numbers? What are next quarter's numbers? When's the next election? 2 years from now, 18 months from now, 6 months? It is a matter of utmost national security for China to be able to invoice commodities in their own currency. Full stop. They need to do that, or they are in way worse trouble than any of the commercial real estate trouble and the stock market trouble. That's like baby trouble. The real trouble is if they lose all of the progress that they have gained in being able to invoice commodity imports in yuan. That gives them flexibility. That is the game-winning move for them. Nothing, in my opinion, will be done that interrupts that. They will rather take the short-term pain in commercial real estate and stocks and all these other littler markets. The big kahuna is the trade. It's the balance of payments. If China does something to try to ameliorate one of these littler market problems they're having by defaulting on foreign debt or whatever, again, outside of war, they will blow up their balance of payments. They will risk blowing it up, right? Now all of a sudden the world's going to say no more yuan for oil. We want dollars. China's importing $1 trillion plus in commodities a year. Maybe it's 800 billion if commodities are down. It's a lot. Huge pressure on their balance of payments. Now, they're not going to do anything, in my opinion, that puts that at risk. So hopefully that helps from a context standpoint. As always, if you enjoy these updates, check us out, FFTT-LLC.com, for more information about what we're up to and about our Tree Rings product, 10 most interesting things every week, what grabbed our attention about each thing, and whether it's making us think more strongly about a way we've been thinking about the world, or maybe changing our view of the world relative to how we had been thinking about it before we read that thing. So, as always, thank you for joining me. Look forward to catching up with you soon. Everybody have a great rest of your week. Take care, everyone.